What's up, guys? Welcome back to the tax strategies of the rich and famous. We're going to start today talking about real estate. This is by far my favorite subject to talk about. As a tax strategist, majority of what I do is teach wealthy people how to get involved in real estate and how to eliminate or reduce their tax liability. And there's no easier way to do that than getting involved in real estate. It is so extremely powerful. But we have to go back to the basics of how your real estate activity is generally. So there's a code section that's called section 469. It is a very, very important code section when you're talking about real estate. Now, the reason for section 469 is so important is because it divides our overall income into two categories. Now, if you remember this last video, we just talked about 4 different types of activity. Okay. Now, for this situation, we're going to talk about 2 types, active and passive. Okay. And so we have active income and then we have passive income. Now, again, the really important part about section 469 is what established the difference between these two, and also states when you have passive losses, those passive losses cannot offset your active income. Okay, so again, your active income, as we already know, is your W-2s, self-employment income, those types of activities that take blood, sweat, and tears in order to generate that income. Okay, our passive is very clearly defined in section 469 as rents. They very specifically break out rents, and I'll tell you why in just a second. Rents, royalties, dividends, and then passive business investments, right? Passive biz investments. Basically anything that you do not materially participate in. So I'm actually going to go through here in a second and talk about what that means in a little bit more detail. I'm going to erase this line here, give us a little bit more room to draw. So back in 1986, Ronald Reagan put into place section 469. And the reason it was put in place is because you used to have all these wealthy individuals who'd make a ton of money through their W-2s of their businesses, and they would take that income, shove it all into real estate or passive businesses or all these other things that would generate losses and then wipe out their income, even though they didn't really do anything with it, right? They would basically take their money and park it somewhere to generate tax losses to eliminate their tax liability. Congress finally got fed up and said, enough of this. We need these people paying taxes. And so they established section 469, which basically says if you do not materially participate in an activity, then you do not get to take the losses against your ordinary or generally earned income. And so they specifically say that rents, even if you materially participate in them, are still passive, and you cannot take those losses against your ordinary income, even if you materially participate. And the reason for this is because the rental portion and rental real estate was the most abused out of all the different types of investments. And Congress was so fed up that they slammed it and said, nope, you cannot take losses from your rental properties against your ordinary income, even if you materially participate. And there are 7 different material participation rules. Okay, the main ones that we look at are 500 or more hours per year spent in the activity, and you only have to hit one of these, or 100 hours or more, plus more time than anybody else, or number 3, more time than anyone else. Okay, so this is why they put into place section 469. Again, the most important part about this discussion when we're talking about rental income is that rents are very specifically broken out in section 469. Okay, now there are ways that we look around. They put in place section 469 back in 1986, and then you had a lot of real estate investors who came out and said, what the heck, we do this for a living, why are we not allowed to take the losses from our activities and apply them against our income? And so what they did in 1992 is they put into place the rules for a real estate professional. And what a real estate professional is it's anybody who spends 750 hours a year or more in a real estate specific trade or business. So there's a bunch of different real estate specific trade or businesses, but in general, they're your real estate agents, brokers, contractors, property managers, land developers, architects, anybody who's erecting buildings. In general, those types of people are your real estate professionals. And the time spent on those activities, as long as you own more than, I believe it's 2% of the business that you're operating in, you can qualify as a real estate professional. And as such, as long as you also materially participate, you can take those losses against your ordinary income. So now we have this doorway into being able to take these losses against our ordinary income. And so we're going to be going forward after this video here. We're going to go into our next subject, which is the different types of losses that we can take from those properties and what that looks like. Okay, so now that we have a general understanding of what section 469 is, we're going to dive into some more specific rules around how we can take those real estate losses against our overall income. Okay.